Hey everyone, this is Michael, and this is the Market Trend Advisory weekend video for March 5th, 2022. And we're going to go ahead and just talk about the current market trend overview. Before we start, I just want to say that the content and information in this presentation is provided for educational, informational purposes only, and in no way should be considered investment advice. So let's start off with our current market trend summary. We have no change from last week. The market's still in a correction. In a downtrend, we have no positions on either the index side or individual stocks or non-index ETFs. Our market count is at 0, and we have 0 market exposure. And we're not counting institutional selling days just because the market's in a correction. And that's the same for the S&P. So we have no change there, though under the surface we have a little bit of change going on, which we'll see in a moment. So if we go to the monthly NASDAQ chart, so it's a little hard to see here just because I can't enlarge these charts, but we're still just below this moving average on the monthly chart. I think that's a 20-month moving average. We've talked about this before many times. This is a channel that's been containing most of the run-up since 2009, and we broke above it, which is usually a sign. Well, it's actually almost always a sign the market's gotten a little overheated, and we've now pulled back to the top of the channel, and it looks like we're just below that moving average. But you could call it, so far we're getting support there. You can see back here in the internet bubble days, we went substantially above it really quickly, so the angle really just went vertical, and then we crashed, I think 82% back then. So a little bit different market here today, but we also have huge trading volume that's come in the last 2 years. So, I mean, you can look at this two different ways. A lot of churning going on. We're making new highs, but the volume was just really, really high also. Relative strength is also dropping versus the S&P, and we've come back down to the top of the channel. Whether or not it's going to burst, it was anyone's guess. My personal opinion, we probably will continue down. That's just how markets work. When they get extended on one way, they usually overshoot the other side. And for the market to just stop and find support at the upper part of this channel and then head higher would be highly, highly unusual. Something we haven't really ever seen. So the odds don't look like it favors that outcome, but this being the stock market, anything can happen, especially if you have a Fed that's been pumping in trillions of dollars. Though that's changing, but that of course has driven all this activity over the last couple of years. Let's look at the same chart in the S&P. It's a little bit worse. We are actually broken a little bit more down below the channel, and we're not quite at that moving average, but we're getting close. So again, the S&P really never got that far above the channel, even going back to the late 90s. So I suspect too here we'll probably have a more substantial correction than the market most people think, but that's just speculation. We'll let the market actually tell us what it wants to do. Here's the NASDAQ just on the daily chart, and you can see that we had a big rally attempt on this day. We had a huge reversal. I don't remember offhand the stats, but I think that was, it was an 886 point rally. It was the largest 1-point gain measured from the opening to close in more than 50 years. As I mentioned before, this kind of activity, and you see this in bear markets, just huge moves up that really just scares all the shorts out, causes all that short covering, which is really what tends to drive these just huge rallies. You can see we had another one over here, opening low and just buyers piling in from the get-go and jamming it all the way up to its close at its highs. But you can see here we've been getting resistance at the 21-day moving average, which is in a nice decline along with the 50-day. So that's really not a good sign. And it got resistance there, which is really this is the first level. Normally in a stronger market, we will at least rally up to the 50-day, which is the red line here, or even the 200, which is flattening out. So this is really not a good sign. We're still a long ways from breaking below that low because that day was almost 900 points. But we're getting close. We might test it or break it. So we don't know at this point, but the rally does look like it's floundering a little bit, and we're getting more institutional selling days, down days on higher volume. We had a number of them over here. I don't have them on this chart. And then we're getting a few here. You can just see these pink spikes here, higher than the day before. So the technical picture doesn't look good, but of course we have now the whole Russian-Ukraine conflict muddying the waters here. So we have that can change in a day if that conflict seems like it may wrap up sooner than what people are thinking. So let's now look at the S&P. It's a little bit better. The S&P's been performing a little better overall, but again, we're getting a lot more big distribution days coming in here, and this is that same rally attempt day. So it looks a little stronger, but we're even curving up here a little with the 21 day. But still, it's not a market that's, we're definitely in a downtrend, and we'll just have to see what happens. Here is the percentage of NASDAQ stocks above their 200 day. We're down to basically, let's just call it 20%, which means that 80% of stocks are below the 200 day. That's just a terrible number, showing you just really under the surface what's going on. That's a pretty bad bear market, probably and for many of these stocks that we're seeing, a lot of the high flyers, the growth stocks, we're on par with what happened in 2000 to 2002, and it doesn't look like we've even hit the bottom yet. So it's pretty ugly. And here's the same thing for the S&P. It's actually dropped a bit, even though we had from a big rally. We're under 50%, so really not a good picture. The one thing I do want to mention here is that despite the markets struggling to get any kind of rally going, sentiment is definitely pointing towards a bottom. You can see here, this is just the latest days. This is the VIX. I don't have the headers here, but interesting, the VIX has been like solid red, around 30 or so for like weeks and weeks and weeks. Strange, very strange, because normally it's in a range from 10 to 15, and then when you get to about 20, that's already showing that fear is entering the market. But we've been consistently above 25 for a long time, so it's a very kind of strange situation. This is the CNN fear greed. We're hitting panic and extreme fear a few days in a row here. So that's also pointing to a bottom potentially forming or hitting soon. Again, these are all contrarian indicators, and sentiment indicators work best on the downside. And this one here, this is the put call, and it's also been elevated and sometimes giving off erratic readings. Normally, when you're getting above 1.0, you would have or 1 to 1.15. It's giving signs of a top. This has sometimes been going down to levels that are pretty neutral. So again, strange indications going on here. And then finally, this is interesting that just appeared. It's the Investors Intelligence Bulls Bears, and we actually just had a crossing here on it comes out every week, and this came out on the 2nd. And you can see here in the chart that it crossed over the bulls now. I mean, the bears are actually now outnumbering the bulls, and this is actually quite rare, and it has a really good indicator of a bottom. Here you can see in 2020 when the coronavirus crash happened, we did cross briefly, and then we came shooting back up. Now, it doesn't always happen. It doesn't mean it's going to happen, but it does say that with all these adding up, we are getting pretty close, at least in terms of sentiment, to a bottom. Now, if this continues to stay down here for a long time and the market can't rally and the technicals continue to deteriorate, that's actually a really bad sign, and that's when you actually can start getting market crashes that happen, where they just wash out all the sellers. So we're going to continue to monitor this, and but that's this is why we look at sentiment, we look at the market internals and the technicals, and then we look at the trend, because adding them all up will sometimes give us a little early warning indicator that the market's going to change. So we're still watching these, but it does look like we may get at least some kind of short-term bottom soon, if not a longer bottom. And then finally, just to wrap it up, investors remain spooked by the Ukraine-Russia conflict. Sorry, I'm missing a period here. I'll just add it in while I'm talking. Inflation and jobs and interest rates are really they're on the back burner again, even though they're super important. In fact, we had a really strong jobs report on Friday, and the market just didn't really respond much to it because of what's happening in Ukraine with the attack on the nuclear reactor. So we continue to expect just volatile day-to-day news-driven movement. Anything can happen. I suspect, again, if the market seems like it senses that there's going to be some kind of ceasefire or a backing off from Putin, we'll probably get another huge up day. Doesn't necessarily mean that's the bottom, but that's just how it works. The market's always looking for some kind of impetus to head higher. And interesting, though, I think we talked about this a little bit last week. Historically, geopolitical events have caused relatively short-lived sell-offs, but in this case, the market's already grappling with high valuations and in a new interest rate hiking environment. So and also we're dealing with inflation. And of course, we have the high valuations. So it could be different this time. And we have many signs of a bubble. We have our ongoing bubble article. All the signs are there of a long-term top. But nobody knows if it's in the middle of developing, if we already are hit the top. It's sort of those are the unknowns. It's highly likely that the market won't be making new highs for a long time, especially if interest rates are going higher and we continue to have the headwinds that we're getting. So really, to wrap it up, it's best to be prepared both for a sudden return to an uptrend. We are, I think, on day 7 of our rally attempt. You saw it on that little arrow on the NASDAQ chart. So we look for a follow-through day on day 4 or beyond. So we're past day 4. So that could happen any day. All that really means is we get a move up of at least 1.25%. Or the more the better on higher volume than the previous day, and that would trigger a follow-through day. And again, to remind you about that, there's never been a market rally or bull market or major uptrend that started without a follow-through day, but it doesn't necessarily mean that the follow-through day is going to work. We've had a couple failures recently where it came back down to undercut, but we do look for that, and that's such a popular indicator now that when that happens, basically all the market participants are now just jumping in, at least in the short term. So we are looking for that. So also at the same time, we want to be prepared for a break to new lows in the indexes. And anything can happen, and we just want to make sure that we're not putting ourselves in a overly biased area one way or the other. Especially when the market's difficult, people tend to tune out. I'd say this is really not the time to tune out. In fact, if you're an avid stock picker, this is the time you really have to put in more work because you're looking for the next batch of leaders. In our stock picks service, what we're really been doing for quite a few months now is we're looking for the highest RS relative strength rating stocks, especially those that the relative strength line is hitting new highs and the stock is not yet. We call those the RS blue dot stocks, and because you'll see that on our charts. And those are just showing that those are the leaders that are currently bucking the trend. They're not going down. In fact, some of them are making new highs. It's been tricky even for that because this market has been, so many cross currents, and we've had, just changing of sectors, rotation going on all the time. So, but you can actually see it, oil stocks and energy stocks and a few other minor chemicals. They're bucking the trend and they're making new highs despite what's happening with the overall market. So that's what we're always looking for. So if this is the time really to be doing your homework, because the next batch of leaders will come out when we ever get into a new uptrend, and there'll probably not be names that you are familiar with or have been invested in before. A lot of the leaders of really the past 5-6 years, all these software names and other names, they're broken. They're down 50, 60, 70%, and really need a lot of work to be able to stop going down, base out, and then start to create new bases that will be viable. But we're months away from many of those, if not years, and many of those will never come back. I mean, there's many stocks that went up in 2000 and never even come close to their highs. And here we are 22 years later. And just the final thing too, in this environment, we're just, one of the things we always look at to as a sort of a leading indicator is how individual stocks are acting. And they're just not acting well. They're pulling people in just enough to think, oh, maybe this is it. Maybe they're returning, and then just within a few days, they just, most of them back off, sell off. We have a lot of huge, down moves on earnings, which is, something we haven't seen in a long, long time. It's been most of the time earnings have been accepted much stronger, but now we're getting big moves down. Sometimes it's out of the blue. Stocks just will go down 15% for no reason. In fact, there's not even any news. And these are leading stocks. They were actually really close to all-time highs. So that's we watch, but overall, that's also not giving us a very good signal. We're just getting very few sectors: commodity, cyclical stocks, energy, and some shipping. They're the best performers, but even they're struggling for the most part. A few of them are acting well, but a lot of them are just not. And there's really just not a lot of stocks setting up and are actually doing well. So the picture's just, it's not a strong picture. It's not a market you want to be invested in right now, which is good because our system has been saying that for a long time. So you really shouldn't be invested much at this point. But really, I guess today the lesson is just to be prepared. Anything could happen, and you can have an ugly market that within a few days it just starts roaring higher and tons of stocks start breaking out, and the whole picture just changes within a very short period of time. Okay, well, that's it for this week. We'll be back next weekend, and we'll see how the market's progressed or unprogressed, if you want to call it, in the week to come. Okay, thank you.